Today, we're pulling back the curtain on the hidden wars waged every single day to protect the global economy. We are diving into the world of financial crime prevention, specifically anti-money laundering, or AML, and combating financial terrorism, CFT. This is all about understanding the sophisticated methods criminals use to clean dirty money and how financial institutions build their defenses, starting with something called customer due diligence.
It's a really essential deep dive. Money laundering and terror financing, they aren't abstract problems. They represent a fundamental threat to economic stability and national security. They let illicit wealth concentrate, warping markets and draining resources that should be supporting the legitimate economy.
And the rule book for this isn't just local, is it? It's aggressively global, which I think is a key part of the pressure system.
Precisely. The global standard setter is the Financial Action Task Force, or FATF as it's known. They establish what's called the 40 plus 9 recommendations. That's 40 for money laundering, and 9 really crucial ones focused on terrorist financing.
That sounds like a technical list, but not following it has real geopolitical teeth, doesn't it?
It absolutely does. If a country doesn't implement and enforce these standards effectively, it risks being, put on a gray list or even a blacklist.
And what does that actually mean in practice?
It means financial isolation. Other nations, major financial institutions, they will literally cease business activities, restrict trade, and pull their investment. This compliance framework is really what holds the global financial system together.
So our mission today is to unpack these criminal processes, understand the countermeasures like CDD, and we're also going to introduce a concept that's becoming more and more central to this framework, proliferation funding,
Right.
which is the financing used to smuggle weapons of mass destruction. So we're talking about AML, CFT, and now CPF. Let's start with the crime itself, the classic one, money laundering.
Okay.
At its core, we are talking about disguising where illegal money came from.
That's the definition exactly. It's the complex process where criminals hide the true origin and ownership of illegal proceeds. Money from, say, drug trafficking, corruption, kickbacks, to make it appear legitimate. They do this by pushing the funds through legitimate businesses, moving them across borders, and really exploiting any gap in regulation they can find.
What's fascinating to me is that the term itself has this surprising historical hook, right? It goes back to the 1920s Prohibition era in the US.
Yes, the term really took off then. Organized crime figures suddenly had these massive amounts of untaxed, illicit cash. Al Capone, the infamous Chicago mob boss, he's the one credited with popularizing the method. He set up a whole network of cash-intensive laundromats.
Laundromats, literally.
Literally. It allowed him to mix the dirty alcohol profits directly with the legitimate revenue from the washing machines.
It's just incredible that a simple dry cleaning operation led to the global framework we have now.
It really is. And what's worth noting is the historical context here. Before the 1980s, money laundering wasn't even seen as a serious crime. Tax evasion was the more potent legal weapon. That's actually what sent Capone to jail in the end. It wasn't until the war on drugs really ramped up that governments began to aggressively target the money itself.
That shift brings us to the structure of the crime. They don't just use laundromats anymore. They follow a continuous cycle with 3 distinct stages.
That's the core model. It begins with placement. This is the most dangerous stage for the criminal. It's where they inject that bulk, dirty money, usually cash, into the financial system.
How do they do that?
They might use fake invoices or, falsified documents to justify cash deposit.
Okay, so get the illegal cash into a bank. Then what? How do they wipe out the footprint?
That's layering. Once the money's in the system, they aggressively move it around to disguise its source. Think of it as just creating complexity. They make deposits, move funds into term deposits, transfer between multiple accounts, often across different countries. The goal is to create such a thicket of transactions that investigators just can't follow the money back.
Obscuring the trail. And then finally, the payoff.
The final step is integration. This is where the now cleaned money re-enters the legitimate economy. They withdraw it to buy high-value assets, real estate, luxury cars, maybe invest in a business. And if they're ever questioned, they can just claim its profit from their earlier, now legitimate investments.
Let's make this real. The source material had a great practical example. The government contractor kickback scenario.
A perfect example. So say a contractor gets a $500,000 kickback for using substandard materials on a public project. That's the dirty money. In the placement stage, instead of depositing it all at once, they might divide it up. Buy a high-end car, make a down payment on a property, put some in a fixed deposit.
So they're diversifying the risk right from the start.
Exactly. This prevents an investigator from tracing the whole amount to one source. After some time, the layering begins. They sell the car, they sell the property, they cash out the deposit, all look like legitimate transactions. Then they send that money abroad, claiming it's for, say, a new business venture. They wait a year, then bring that same money back home, but now it's declared as foreign direct investment.
And the original source is completely disguised. It looks like clean foreign capital.
Completely. And modern techniques only make this harder, especially a practice known as structuring.
Right, that's where they avoid the detection threshold.
Yes, it's critical for them. If a bank system flags any transaction over, say, $10,000, a criminal with $100,000 in cash will just break it up. They'll make $5,000, $10,000 deposits at different branches or mix cash with checks, anything to divert attention.
And this has now expanded way beyond just traditional banking.
Oh, absolutely. We see very sophisticated trade-based money laundering. They use things like false invoices, where they'll over or undervalue commodities to move huge amounts of money invisibly across borders.
And what about those carousel transactions?
That's the most complex. It's the repeated importation and exportation of the same high-value item, sometimes only on paper, just to move wealth and disguise illicit proceeds.
And now we have a whole new generation of methods, right? Dummy purchases on online marketplaces, gift cards, even virtual currency in online games.
And of course, cryptocurrency. Although regulators are catching up there, it's still a challenge. All methods designed to misguide investigators.
Okay, that's money laundering, which is driven purely by financial greed. But let's shift gears now to terror financing, or TF, because it uses similar methods, but the source and the goal are totally different.
And that legal distinction is crucial. Terror financing involves using any amount of money, and this is the key, whether the money itself is legitimate or not, to promote or support terrorism.
So wait, that's the biggest challenge. ML is about cleaning dirty money. TF can be about using clean money for a dirty purpose.
It creates a massive loophole for them. The source of funds can be perfectly legitimate. It could be diverted funds from charities, profits from legal or business, or just self-funding from wealthy supporters.
Yeah.
But yes, they also draw from illicit sources, drug trafficking, fraud. The source is secondary. The intent is everything.
And the cycle looks different too. It's not about making more money.
No, it's typically a linear process. It starts with raising funds, gathering the money quickly, often avoiding formal systems to stay untraceable. Then comes moving funds, dispersing that capital in multiple forms, small wire transfers, cash smuggling, and distributed among different people to stay under the radar.
And the final step.
Using funds. The capital is forwarded to the handlers, usually as untraceable cash or gifts, for logistics, travel, materials. It's extremely hard to track at that final stage.
So before we compare ML and TF, we promised to touch on Proliferation Funding, the PN in AML CFT-CPF. Where does that fit in?
Proliferation Funding is related but distinct. It focuses on a very specific, devastating risk: financing the smuggling or production of weapons of mass destruction, chemical, biological, nuclear assets. So unlike ML, which is about hiding wealth, and TF, which is about financing violence, PF is narrowly focused on the materials and logistics needed to get those specific banned goods.
So the investigation isn't about tracking billions of dollars, but maybe smaller transactions for specific dual-use materials or tech.
Exactly. It requires a different type of vigilance, often focused on trade finance in specific companies rather than just large cash deposits.
Okay, so if we synthesize the 3ML, TF, and PF, what are the key takeaways?
It really boils down to motivation and purpose.
Yeah.
ML is for financial profit. TF is purely ideological violence. PF is for strategic destabilization. ML is cyclical, wants to generate more wealth. TF is linear, the funds are raised to execute a future act.
That brings us from the criminal side to the defense strategy, which starts the moment the client walks in the door. AML regulations force institutions to follow a risk-based approach, and the foundation of that is customer due diligence.
CDD is the foundation of the entire defense. It's the systematic collection and assessment of a customer's information to make sure they are who they say they are and that their transactions match their profile.
And the crucial first step in that is know your customer, KYC.
KYC is absolutely mandatory. It requires gathering basic ID, full name, date of birth, address, profession, and critically, the source of their income or funds. This gives you the baseline you need to predict their transaction behavior.
So it's not just about paperwork, it's about judgment, right? The bank officer is meant to reconcile the documents with, what they're seeing and hearing from the customer to establish a realistic baseline.
Absolutely. If a customer claims a high salary, but their documents don't support that, the institution has to dig deeper. And based on that initial risk assessment, we apply different levels of scrutiny.
Right, from simplified to enhanced due diligence. SDD is for the lowest risk customer.
Correct. For a salaried person, for example, whose income is predictable, the risk is low, and SDD, just basic verification, is enough.
Good. Then you escalate to EDD, enhanced due diligence. When is that deeper investigation needed?
EDD is mandatory when higher risks exist or when any ambiguity comes up. A classic trigger is a discrepancy. If a client shows evidence of a $5,000 monthly salary but says they'll be transacting $50,000 a month in their new business account, EDD is necessary to validate that.
And certain professions are just automatically high risk, triggering EDD almost immediately. We're talking about professions that can hide ownership.
Exactly. Traders, commodity dealers, art dealers, accountants, lawyers. The reason is structural. These professions often involve creating legal entities where the beneficial owner, the person who ultimately controls the funds, can be hidden from the apparent owner on the documents.
The art dealer example is perfect. Why are they so high risk?
Because art is one of the easiest ways to move vast amounts of wealth invisibly. Art valuation is subjective. Ownership can be transferred anonymously and rapidly across borders. It's ideal for the integration stage of money laundering.
So EDD measures go deep. Getting senior management approval, meticulously establishing the true source of wealth, and implementing enhanced ongoing monitoring for the entire relationship.
That's how you try to level the playing field.
Okay, so clients are onboarded and risk rated. How do the systems then catch the actual suspicious transactions in real time?
Financial institutions use transaction monitoring systems that analyze billions of data points, searching for any deviation from that established customer profile. These systems generate red flags that alert the staff.
What are the biggest indicators that trip those alerts?
Well, the primary one is the economic sense test. Transactions that just lack any logical financial rationale. If a retired person's account suddenly shows large international business-to-business transactions, that makes no sense. Another is the business consistency check. A small wholesale business that suddenly gets huge payments from, say, oil or defense companies.
And of course, structuring, which we mentioned earlier.
A major red flag. The intentional breaking up of transactions. 5 cash deposits of $9,500 instead of one larger one. We also look at investment behavior. Sudden, short-term investments with minimal profit, followed by a premature withdrawal. That often means they're just using the investment to layer the funds.
And before anyone is even onboarded, every client is screened against international sanctions lists. But one classification always triggers maximum scrutiny: the PEP.
The politically exposed person.
Yes.
These are individuals entrusted with prominent public functions. Heads of state, senior politicians, influential government officials. They're automatically marked as high risk.
And the danger isn't that they are criminals, but that they have the potential to manipulate public systems.
Exactly. Because of their access to public funds and power, the risk of bribery or corruption is just inherently higher. Any relationship with a PP or their family requires mandatory measures: senior management approval, establishing the source of wealth, and hyper-vigilant ongoing monitoring.
Now, when a red flag is confirmed and there's a real suspicion, what's the internal procedure?
The suspicion report goes to the Money Laundering Reporting Officer, the MLRO. If the MLRO agrees the activity is genuinely suspicious, they file a suspicious activity report and a SAR to the National Financial Intelligence Unit, or FIU.
I want to clarify some jargon there. We sometimes see reports called STRA or STRF. What's the difference?
That's just how the FIU categorizes the suspicion. STRF is focused on the financial element, the size or location of the money. STRA is focused on the activity or behavior like structuring patterns, regardless of the amount. Both are critical.
And there are two crucial rules here that protect the whole system.
Correct. Staff have legal immunity for reporting SARs. They can't face repercussions for filing a good faith report, but the counterbalance is strict. Tipping off a customer, telling them a SAR has been filed, is a severe criminal offense.
So bringing it all together, the AML officer is the first line of human defense. Their job is immense.
It is. Their main objective is to eliminate money launderers and terror financiers from the system. They do the KYC, perform the risk-marking high-risk accounts reviewed annually, medium every 2 years, low every 3, and they initiate EDD when patterns deviate. They are the eyes and ears.
And the MLRO is like the central command.
The MLRO is responsible for the entire AML compliance ecosystem, establishing policies, being the internal point of contact for staff suspicions, investigating those reports, and ultimately filing the SARs to the FIU.
And we should definitely emphasize the protections for people who speak up.
The legal framework is very clear. There are robust protections for whistleblowers. Employers are prohibited from retaliating, firing, demoting, harassing employees who report suspected money laundering. It ensures staff feel safe.
We've taken a really comprehensive dive today, tracing the process from Al Capone's simple cash mixing all the way to complex global trade fraud and proliferation funding. We've seen why EDD is so crucial for high-risk individuals and how the MLRO acts as the linchpin.
And these AML, CFT, and CPF frameworks, they're not just banking bureaucracy. They are the essential mechanisms that protect economic integrity and societal safety by forcing everyone to constantly adapt against these evolving threats.
And that leads us to our final provocative thought for you to mull over. We noted that money laundering works cyclically. The laundered money feeds back into generating new illegal money.
Right, while terror financing is typically linear, with funds used to execute a singular act.
This raises a big question.
It does. Given its cyclical, self-perpetuating nature, is the long-term systemic economic damage caused by money laundering, the constant poisoning of market integrity, potentially more entrenched and harder to eradicate than the funding streams that fuel terror financing.
And what does that distinction mean for how global compliance efforts should prioritize their focus and allocate their limited resources?
Something to think about.
Something to think about long after this deep dive ends. Until next time, stay well informed.